All right, dear students, welcome. In this lecture, we are going to discuss what is asset, what is liability, and the capital. We'll be discussing few more terms after that, but the main concern will be discussing the asset, liability, and capital. Now, when you are dealing with the accounting, when you are studying the accounting, whether it is your any paper of accounting, you will be dealing with these terms. In fact, when you're doing a business, in fact, when you are doing the business transactions, then you will see these terminologies used everywhere. So that is why it is very important for the businessman, for the accountant to know regarding these terms. In the last lecture, we discussed introduction to the business. We discussed what is business and what is the types of business, and we discussed the advantages and disadvantages of every form of business. Now we are moving one step further and we'll be discussing the asset, we'll be discussing the liability and the capital. Now the first thing you need to understand that whenever an entity is starting a business, they will have some resources. They will have some possessions. They will have some holdings. Like say for example, I'm going to start the business of the fashion goods. Like say for example, I am selling the denims. I'm selling the denims for like denim shirts, denim pants, denim wallets, denim perfumes, toiletries. So I have a brand which is known as the denim. Now I am selling the denim products. So obviously those products which I am selling is in my possession. I have to sell those products under a brand name. I need a retail outlet for that. So I buy a shop for myself in order to sell my products. So now I'll be having a shop in my possession as well. So I have a retail outlet, which is a shop. In that shop, I'll be having the furniture, I'll be having the aisles, I'll be having the shelves, I'll be having the furniture, I'll be having the air conditions, LED and things like that. Then I'll be having the denim products which I'm selling. So that means when I'm doing a business, I will have multiple resources, multiple possessions, multiple holdings with me. So I am starting a business, I am going to deal with resources, possessions, and holding. Now, when we are talking about these resources, possessions, and holdings, I may have some responsibilities. I may have some obligations. For example, in order to make those denim products, I bought a material from the supplier. The supplier gave me the credit. That means I have to pay him for those materials after a month. Now, this is my responsibility. This is my obligation that I have to pay them that sum. Similarly, I may need a loan from the bank in order to buy a shop. So what I did, I just went to the bank and I said to them, I need this much amount of money to buy the shop, and they gave me the money. That was the borrowing which I did from the bank. This is known as the obligation and the responsibility. Similarly, when I'm starting a business, I need the investment. I need the startup funds in order to start my business. So simply, the resources, the possessions, and the holdings of the business are simply known as the assets, and we'll be dealing with that in a while. In addition to the resources, possessions, and the holdings, the business may have some obligations and responsibilities, and these are known as the liabilities. And obviously, in order to start your business, in order to fund your business, you need the startup funds, you need the investment, and that is known as the capital. So we'll be dealing with the asset, we'll be dealing with the liability, and we'll be dealing with the capital in this video. Now, first of all, starting with the asset. If you search this term into the Google or the dictionary, you will be getting some plain meanings of the asset, such as it's a resource. Now, anything is a resource which you have. For example, I have my laptop, which I'm using to teach you guys. This is my resource. I have a notepad on which I'm writing. I have a writing pad on which I'm writing, which you can see on your screen is actually a resource which I have. I also have a smart PC which supports me sometimes in order to make videos. This is a resource which I have. I have a room in which I'm sitting and taking the class. This is a resource I have. I have kept my laptop on the table, which is actually a resource I have. So resources are the things which actually I possess. So these are my possessions. These are the things which I'm holding. So these are also known as the holdings. But remember all the examples I gave you, like I am having a laptop and a writing pad through which I'm teaching you guys. You guys are paying me, and obviously I'm earning this much amount from your courses. So that means I am using my resources in order to earn something. Similarly, I have my smart PC, which I use to make the videos. That smart PC helps me to generate the money. That resource is actually helping me to gain some money, to earn some money, to have some benefits of it, out of it. So the businesses, if they have the machinery, they will be producing something. Like for example, I talked to you regarding the denim. For example, the denims. Now these, in order to make these denims, you need the machinery. Similarly, you may have the generators. Sometimes you do not have the electricity, or sometimes you have to meet the electricity requirements. So you have the generators for it. You have the furniture. All these things are assets. So asset is something valuable, which a business owns or can use. The International Accounting Standard Board, IASB, means International Accounting Standard Board, which makes the standard for the accounting. International Accounting Standard Board. How they make the standards, we'll be dealing with that in the framework chapter. International Accounting Standard Board. So they defines the asset as asset is a resource. As I told you, all these things which are in my possession are actually the resources controlled by the entity as a result of the past events, and from which future economic benefits are expected to flow to the entity. Now, it is very important to understand this definition of asset over here, because you will be using this definition throughout your syllabus, throughout your ACCA course, and throughout your professional career. So that is why it is important to know what this asset is all about. Now, the first thing they said, that asset is actually a resource. Now, we have already discussed this thing. The second thing they have discussed is actually controlled. When I initially discussed the plain definition of the audit, it's actually discussed an asset is something which a business owns. Now, there is a clear difference between the owns and the controls. Now, we have to deal with this difference because this will be used in a future. When you talk about the owns, that means the ownership. When you talk about the control, that means the risks and rewards. Let me give you a plain example, and then you will be able to get the difference between the owns and control thing. Now, say for example, you have a transportation business. For example, you have a transportation business. Now you have a transportation business, you owns the cars, you owns the buses, you owns the lorries which are being used in your transportation business. Now, say for example, you are actually needing a van for your business, but you are not having a cash to buy the van. So what you actually did, you went to a leasing company. You went to a leasing company and you said to them, I want a van on the lease. Now, the leasing company is simply that you will be getting the van and you will be paying the monthly or yearly installments because you are not having the cash to buy it from the market itself. So you are leasing it, you are buying on installments. All right, you met the criteria, what the leasing company said, and you actually leased a van. Now you will be paying for this van on installments unless and until you are clear with all those installments. The van will remain in the ownership of that lease company. If you look at the registry, if you look at those ownership documents, unless and until you are clear with all the installments, with all the money you have to pay, it will remain in the ownership of the lease company. So if you talk about the own thing, this van still belongs to the leasing company. But remember, in accounting, when we are dealing with the accounting, we always apply the principle of control. Now, that means we are talking about the risks and rewards. Who will be using these vans throughout? It is the business who will be the transportation company who will be using the vans. Who will be getting the benefit of these vans? It is the transportation company who will be getting the benefit. Who will be fixing it when it got some problem? It is going to be the transportation company who is going to fix it. What if it had some accident? Who will be responsible? It will be the transportation company who will be responsible. That means the risk and rewards related to this van lies with the transportation company. So in substance, this van belongs to the transportation company rather than the leasing company because they just own it in the legal papers. Otherwise, this thing belongs to you in substance. So remember this thing. Whenever we are talking about the accounting, whenever we are dealing with the accounting, we have to make sure that we are actually using the control term rather than the own term. Because it is possible that you have some asset, you are using it, you're having the control over it, but in a legal terms, it is not yours, maybe due to any reason. Like say, for example, I am going to buy a car for my business, but already I'm having the car on my name. So for example, legally it is not possible to take another car, but I need a car for my business. What I do is I take the car on my brother name. Now in legal term it belongs to my brother, but still my business is using that car. If you see the legal papers, the ownership belongs to someone else, but if you see the control thing, it belongs to me. So in the accounting, you will always be looking at the control thing rather than the own thing. This is the first thing you need to understand. Hopefully you understood it. So an asset is a resource controlled by the entity. By control means that they will be taking the decision related to that asset. They will be having all the risk and rewards related to that asset. As a result of past event, that means actually this belongs to you, and this is as a result of past event, like you leased it in the past, you bought it in the past, and from which future economic benefits are probable, are expected to flow. Now when you say expected to flow, that simply means probable. You expect that you will be earning something out of it. When you are leasing the van, you are having an idea that you will be using this van for school purpose, for the transportation of school. It is going to be a school van and the school will be paying you for the transportation. You will be getting benefit from it. Now, as the result of past event, that means if you are thinking to buy something, that is not going to be counted as an asset. If you are thinking to buy something, It should have been actually there. It should exist rather than like you're thinking something to buy. If you're thinking something to buy, you cannot record that thing as an asset. So it should be as a result of the past event. This is a very important definition that you need to understand even for your papers, for your complete ACCA, even for your professional career, because when you go to the interviews, they ask you regarding this thing. So this is a very important thing you need to understand. Now we are moving towards two types of assets. Two types of assets. So two types of assets are the current assets and the non-current assets. So first of all, let's understand this thing and then we can read it, what I have written on the slide. Now, I told you regarding the resources, I told you regarding the possessions, and I told you regarding the holdings. I started the business of denims. Remember, the name of my business was Denim Store, if you remember. So what I do possess in this, I have an outlet, actually a shop which I have bought. And then within the shop, I have furniture. And then I have the air conditions, ACs. Then I have the denim products, which I am selling. So you can refer this thing as goods or stock or inventory. So I have these things. I have the outlet, I have the furniture, I have the air conditions, and I have the denim products which I am selling. Now, all these possessions are in fact the assets. Outlet is an asset, furniture is an asset, air condition asset, denim products assets. But we have to classify it between the current and non-current. Now, the first difference you need to understand is actually when we are talking about the non-current assets, when we are talking about the non-current assets, these are assets for the business use. Pay some attention and then you will easily understand what I'm saying. When you talk about the non-current assets, these are the assets for the business use and not for resale. We do not have any intention of selling those things in the ordinary course of business. Now, this does not mean that I'm not going to sell it anyways, like I'll keep it till the day of judgment. No. I may sell it when there is requirement, but selling these things is not my business. Like say for example, in my denim store, there is a furniture. Why I am having a furniture? Because the customers are coming. Sometimes they need to sit, so they are sitting and watching the products, looking at the products. Sometimes our employees, when they are free, they need to sit. So we need the furniture. But selling the furniture is not our business. We are not a company which sells the furniture. This furniture is actually for business use. This is not for the resale. Similarly, I'm having the air conditions in my outlet, and obviously that needs to maintain the temperature, but we are not an electronic company which is selling the air conditions. So there are some assets in the business which are for business use, and these assets are not for resale. The third thing you need to understand regarding the non-current asset is actually the life or benefit is more than 1 year. So life or benefit is more than 1 year. What about the shop? Do we have a property business? No, we are not having a property business. This shop is for the business use. This outlet is for the business use. What about the furniture? Are we selling it? No. The selling of furniture is not our business. We are just using it in the business. Do we sell air conditions? No. It is just to maintain the temperature. We are using it in the business. Do we sell denim products? Is it our business? Yes. So out of these four, the first three are the non-current assets. because we are using those things in the business. We are not selling those things in the ordinary course of business. That means we do not sell those things. And the third thing is that their life and benefit is more than 1 year. What about the shop? You can use it for eternity. Furniture, obviously, at least 5 to 10 years, going to support you. Similarly, the ACs, you can say if the technology doesn't change, you can use it at least for 5 years. So these are the assets which are for the business use. We do not sell it. Our business is not selling furniture, ACs, and shops. We are not a property business, neither furniture nor electronics. We are using it for the business, and their life is more than 1 year. So these will be classified as the non-current asset. Now the rest of the things will be the current asset. Now how we can describe the current assets? The first thing you need to understand regarding the current asset is that we're gonna realize these within 12 months. So the benefit will be received within 12 months. Regarding the non-current asset, the benefit was more than 1 year. And that benefit was coming with the use. But in the current asset, if you talk about the current asset, this benefit will be coming from the sale. Like the denim products, we expect that all the products on our shop will be sold within 12 months. Every business knows this thing. Maybe some products are not sold within 12 months, but we expect that these all will be sold within 12 months. So we're going to keep it in the current assets. Similarly, if we have sold some products on credit, now we have sold some products on credit, it will give rise to a debtor or receivable. Receivable is the person who owes us money, from whom we have to collect our money. Because we sold them the products on credit, they will be paying us at some point in future, for example, within 20 days or 30 days. So this is our resource as well, because we have to take the money from them. So because they owe us money, they are the resource, because we'll collect the money from them, and money is itself a resource. But we're going to collect the money from them within 12 months. So this is the current asset. So remember that current assets are the assets which are going to be realized within 12 months. And again, these are either the goods or they are the receivables who owes us money. So these are the liquid assets. Now, when you talk about the liquid assets, that means easily convertible into cash. Easily convertible into cash. Like for example, if I want to sell my furniture because I need to buy another one, I'll be able to face difficulties because I have to search someone to send my furniture, then I may not be selling it on a reasonable price. I may struggle to sell it. But if I want to sell my product, it is easier to sell because people know where to buy it. I have my own store, I have my own Facebook page, I have my own website where I can easily sell those things. So current assets are the liquid assets. They are easily convertible into cash. Similarly, the person who owes us money, we can collect them easily. Like we call them, you owe us money, send to us in the form of cash or transfer us in our bank account, etc. So there is a big difference between the current asset and the non-current asset. Now we can read what I have written on the slide and you will be able to understand it quickly. So the current assets that are expected to provide economic benefit in a short term. That means within 12 months. This is the first thing. Example of assets that are owned are inventory, which is the stock we are selling, the cash we are having. An example of asset are owed is the money owed by the customers, which is known as the receivables or the debtors. Now the non-current assets. Assets that have a long useful life and are expected to provide future economic benefits over several years, that means more than 1 year. Examples are property, plant, and equipment. A machine, for example, might be have expected to have a 5 year useful life. These are the non-current assets, also known as the fixed assets. Now remember, say for example, I have a denim store and I have ACs in that. Selling the ACs is not my business. I'm just using it for my business to maintain the temperature. And those ACs will give me the benefit for more than 1 year. Now these are the non-current assets. But what if you go to an electronic shop, for example, Samsung shop, and they have the ACs on the display. They have the ACs which they are selling. Now, obviously, those ACs over there in their outlets, or those LEDs or screens you see on the Samsung outlet, they are not for the business use. They are actually selling it. So you go and select your product, and then they're going to give you that product. So that means those products which they are selling on their shop, which they are selling on the shop, the Samsung, these are the inventory. For them, it is the non-current asset. So the ACs you are having on your shop, you're using it on your denim store, is actually the non-current asset. But the Samsung, which is selling the ACs, for them it is going to be the current asset because they are not using it, they are just selling them to the customers. So this is very important. Two types of assets, the current assets and the non-current assets. And then the non-current assets have two further types. Tangible non-current assets intangible non-current assets. Now, the tangible non-current assets means tangible means which have the physical existence. Which have the physical existence. Now, physical existence simply means that those things can be touched. Like say, for example, machinery, for example, furniture, for example, ACs. These are the tangible non-current assets. Intangible assets means which does not have the physical existence. For example, copyrights. Like if you have a product and you have taken the copyright that no one can actually use that thing on their own name, this product belongs to us, this books belong to us. So that means we have actually taken a resource that no one can gonna use it for a certain number of years or for a certain period. Similarly, if you have acquired a license to make a product for number of years, this license is actually a resource. This is intangible non-current asset. So copyrights, license, patents, goodwill, these are the intangible non-current assets. We have the separate topics in our syllabus when it comes to the detail. So two types of assets, the current assets and the non-current assets. Now, liabilities. As I explained you in the first slide, that the business have some responsibilities, the business have some obligations. Now, these obligations have a different context. Like say, for example, you bought the material from a supplier So you bought a material from a supplier on a credit of 30 days. That means you have to pay them within 12 months. The second case is you took a loan from bank for 3 years. So you have to pay them within a 3 year time. So this is more than 12 months. So remember, just like we were having the two types of the assets, the current assets, the short-term assets, and the non-current assets, which were the long-term assets, the fixed assets, we have the same division of the liabilities, the current liabilities and the non-current liabilities. So the obligations which you have to pay within 12 months is your current liability. For example, trade creditor. Trade creditor means to whom you have to pay for the supplies you have bought on the credit. You owe them, you have to pay them. Non-current liabilities means which are outside the span of 12 months, more than 12 months, such as you took a loan from the bank for 3 years. This is a non-current liability. So a liability is something which is owed to somebody else that you have to pay. Liabilities is the accounting term for the debts of the business. That means you have the responsibility to pay it. Now the IASB actually had a definition. A liability is a present obligation. Like if you are thinking that I'll be having a contract with someone and then I have to pay him, this is not a liability because it should be a present obligation. You should be currently in the contract. You should have a current obligation, a present obligation, an existing responsibility to pay. If you think you have to pay in the future, this is not going to be a liability. So liability is a present obligation. That means it should exist now of the entity arising from the past event, the settlement of which is expected to result in an outflow from the entity of the resources embodying economic benefits. When you will be paying your liability, it will be something going out of the business. For example, when you are paying your creditor, your cash will be decreasing. If you're paying from the bank, your bank balance will be decreasing. So there will be an outflow of the benefits. Outflow of the benefits means something will be going out of the business when you are settling your liability, when you're paying your liability. So the examples are the trade payables, which is also known as the trade creditors, and the bank loans, which we have already discussed. Now we have the capital or equity. So again, going back to the first slide, which we discussed, when you are starting a business, you need the startup funds, you need the investments in order to start your business. That is known as the capital or the equity. So the amount invested in a business by the owner are amounts that a business owes to the owner. Now the separate entity concept, do you remember that we treat the business and the owner of the business as two separate entities? So whatever the fund is invested by the owner in the business is known as the capital or equity. And actually, it is the liability of the business to repay that thing to the owner in terms of profits and things like that. So this is something you need to understand. And when you talk about the companies, the companies are actually run in a different way, as we discussed in the last lecture, that the shareholders actually give their money to the directors and directors actually running the company. So in terms of the companies, we call that thing as equity, which is the shareholders investment, shareholders capital, shareholders investment. And the IASB defines the equity as equity is the residual interest in the assets of the entity after deducting all of its liabilities. This is also known as the net assets. That means the assets minus liabilities. Now, say for example, I have a business and my all resources, all the assets worth $100,000. Similarly, I have some obligations to pay, which are $20,000. So what is the net worth of my business That means $80,000. This is assets minus liabilities. I have the assets of 100,000. I have the obligations of 20,000. What is the equity? In fact, the equity is the net assets. Assets minus liabilities. Because I cannot say my equity is 100,000 because we have to deduct the liabilities from it as well. In short, we have to deduct our liabilities. Why is that? Because ultimately the 20,000 is something which we have to pay. Now the next is the revenue and the expenses. Now the first thing you need to understand is actually the revenue is the income generated by the operation of the business. Now you go back to the example in which I was selling the denim products. When I sell the denim products, say for example the denim shirt, my business will be receiving something from the customer. If we are selling the denim pants, jeans, we'll be receiving something. If we are selling the denim perfumes, we will be receiving something. So it's actually the income generated by the operations of a business for a period. Expenses are the cost of running the business for the same period. Now we have an outlet, we'll be having the utilities like electricity expense, we'll be having some other utilities we have to pay to our employees, their salaries. So those are the expenses. Now, IASB has defined the income, revenue, and expenses. The first thing you need to understand is the differentiation between income and revenue. Differentiation between income and revenue. Now again, coming back to the example which I said to you, I have a denim store. I have the denim store. Now what I actually sell, I sell the denim products. Whatever I am getting, whatever I am getting by selling the denim products is the revenue. So revenue is the income which is coming from the ordinary activities of the business. Right? For example, there is a person who wants a stall outside my denim store. A stall to sell, for example, a corn. They want to sell the corns. A stall outside my store. And they said, can you give me a space, a bit space to open up my stall to sell the corns? And I'll be paying you the rent for that. I have my own shop and they want some space, and for that space they will be paying me the monthly rentals. Now when I'm receiving this rental, this is going to be the income for the business. Now there's a difference between the income and the revenue. Both is in terms of inflows, both are same. Revenue is bringing inflows, income is bringing inflows. But the revenue is the income which is coming from the ordinary activities. So my ordinary activities to sell denim products. So if I'm selling denim shirts, denim pants, perfumes, toiletries, I'll be getting the revenue. But if I am getting any other income, that will be classified as income. For example, there's a stall outside my shop and we are receiving the rent. For example, I was having the furniture which I sold and I sold it on the profit. I bought it for less and I sold it for more. That is again going to be the income because the income we are receiving from selling the furniture is not something that or ordinary activity. So income increases in economic benefits during the accounting period in the form of inflows and enhancements of assets or decreases of liabilities that results in equity other than those relating to the contributions from the equity participants. This is the definition they have given. Now, income is increases in the economic benefits because it is bringing something to the business. in the form of inflows, for example, you're receiving the rents, or decreasing the liabilities. Now, this is the point you need to understand. For example, I owe someone $100. They said, okay, if you pay me this $100 within 3 days, I'll be giving you a $10 discount. That means you will be paying us $9.90. Now I was supposed to pay them $100, but now I'll be paying them $90. This 10 which I am paying less is actually the income. Now how this is income is coming in the form of decrease in the liabilities. This is something you need to understand. So how the income will increase the equity, because obviously all the income belongs to the owner, and owners have their equity. So whatever the profit it is producing will be added to their equity. Now revenue is the income from the ordinary activities of the business, and expenses are the decreases in economic benefits during the accounting period. This is opposite to the income, such as we have the utilities, such as we have the staff pay, the payroll, such as we have to pay the tax, such as we have taken the loan and we have to pay the interest, all will be the expenses. And income minus expenses is actually the profit. If his income is more, expenses are less, it's profit. If his expenses are more, income is less, then it is going to incur a loss for the business. Now we have the drawings. Drawings is what the owner of the business takes from the business in the form of cash or assets for his or her personal use. Now again, continuing the example, I have the denim store and I need a perfume for myself. So I took a perfume for myself from my business. This is known as drawings. If I took some cash from the business and I ate something from it, this is also known as drawing. But if I took the cash from the business in order to pay the utilities of the business, this is not the drawing. This is the expense. If I'm taking the cash or the assets for my own use, that is known as a drawing. So if the owner of the business withdraws something, whether in the form of cash or in the form of assets, goods, that is for personal use, that is known as the drawings. Ultimately, drawings are a reduction in capital. Like for example, I brought 10 perfumes to sell, and I took one perfume for my personal use. Now that means ultimately I have invested 9 perfumes in the business. So drawing is ultimately a reduction in the selling price. So that's it. We have discussed the assets, we have discussed the liabilities, we have discussed the capital, income and expenses, revenue, and the drawings. Hopefully you understood everything.